So you're an option trader and you're biting your nails going into Friday's expiration. The stock's really close to the strike price, but it finishes out of the money. So you think you're free and clear. You think that option is going to expire out of the money. Is that actually the case? Can an out of the money option still be exercised? The answer to that might surprise you. Before we get into that, make sure you hit that subscribe button. Make sure you hit the notification bell as well to be notified when new videos and new education is sent out to you. So you get to that point of expiration and it's expiration Friday. Well, I don't like that they call it expiration Friday because truly expiration is Saturday. You have Friday evening after the market is closed to determine whether you want an option to exercise or not. So if I go out and buy an option, even if it finishes out of the money, I could instruct my broker to exercise that. That means that if you're short an option, if you sold it and you think, oh, I'm free and clear, it's not going to exercise. Well, not so fast. We don't know. Remember, the exercise is up to the buyer. The buyer of the option has the right, or AKA the choice, or AKA the option to exercise. It's up to the buyer of the option. The seller of the option has made a promise, and it's not up to them. They don't know whether or not the option is going to be exercised. And every once in a while, there's a situation where an out-of-the-money option will be exercised. So what is that? Well, this past weekend, we had one of those scenarios. On Friday, after the market closed, and Friday monthly expiration for May had passed, right? We got to the close and you think, okay, this stock finished below that strike. It's out of the money and so forth. Well, after the close, Moody's came out and downgraded the U.S. debt, and the futures and stocks started to sell off on that news, and they sold off about 1%. So if you're sitting there in a $50 per share stock or a $100 per share stock, and you think, oh, that option finished out of the money, well, if it sold off 1%, maybe the stock was at 101, let's say 100 per share, 0.50, right? $100.50 per share. If it sells off 1%, that's $1 per share. Now it's at $99.50. Now that put option went from, well, it was out of the money, now it's in the money. That call option went from, it used to be in the money when the market closed, now it's an out of the money. And so the buyer of those options will look at that stock moving in after hours, and they're going to make their determination based on that after hour movement. Why? Well, let's imagine that I own a put. Let's imagine that I own the 100 strike put in that scenario. The stock finished up above it, and I think, oh, my put's worthless. Well, I'm watching the after hours, and the stock sells off. Now, I know my put is now in the money based on where the stock is trading after hours. If I'm really smart and I don't want to risk Monday's open, what I'll do is I'll go buy the shares in after hours at $99.50, instruct my broker to exercise to sell the stock at 100, right? When I exercise a put, I get to sell 100 shares at the strike price. So I bought at $99.50. I exercise my option to sell at 100. I don't have any risk to what happens on Monday, and I've made that 50 cents. I got 50 cents back out of the option trade, even though I thought it was expiring out of the money. Or in another scenario, maybe good news came out and stocks were shooting up. If stocks were shooting up, sometimes a company will be added to the S&P 500 and its stock will shoot up on Friday after the close. If I happen to own a call option, I would see the stock. I thought that call was out of the money. Now the stock shot up above it. I'd say, okay, I'm going to be smart about this. I don't want the gap risk on Monday. I'm going to short the shares in after hours trading, contact my broker, say, hey, I want to exercise this call option to buy the stock down here. I've shorted in after hours, the buy exercises, and I made that little difference between the prices. Now my option didn't expire worthless. And if you think about that, it might be 50 cents per share. You might be saying, oh, that's only $50. Well, if I have 10 contracts, that's $50 times 10. That's $500 we're talking about. So it's not insignificant sums. So everyone that trades options has to understand that just because on Friday the stock closed at where you think it's probably out of the money, it's probably in the money, you don't know for sure until Saturday whether the buyer on the other side has exercised their option. And if you're the buyer, if you're long that option, then you want to be watching after hours to determine whether or not you want to exercise an option, whether one has moved after hours and it was out of the money and now I can exercise it in the money. And if you're pretty smart about it, a lot of times shorting some stock or buying some stock to offset that, now you don't have the Monday gap risk and you just get to lock in that little profit. So this is, I get it's an advanced topic. It's a little bit high level, but the more you know, the better equipped you're going to be. And we believe education here at the Cashflow Academy is what takes you to the next level. So if that's, if I'm speaking Greek and you didn't understand everything, make sure that you get into our 4 Pillars program. Go to the Cashflow Academy, get involved in the 4 pillars so that you can understand fundamentals, technicals, your cash flow, which is option strategy, positioning, and risk management. Get as much education on those 4 pillars as possible, and you will be better equipped to handle the market's volatility and to be able to thrive throughout that volatility. Hope you've enjoyed today's video. Hit that subscribe button, get involved, get educated, and we'll see you in the next one.